Is Copilot Microsoft's new growth engine, and is it at risk now with everything that is going on at OpenAI? Well, let's explore these questions and analyze Microsoft financials. Stick around as we cover key aspects and provide insights that will save your time and enhance your understanding. Now, let's go. Moving beyond financials, recent collaboration signals a broader impact on Microsoft. IT service firm NTT Data plans to integrate Microsoft Copilot AI tools, showcasing the growing influence of Microsoft's AI in various sectors. Meanwhile, OpenAI, backed by Microsoft, is set to introduce a ChatGPT into classrooms, tapping into the booming $10 trillion online learning markets by 2030. Despite concerns, the educational sector is embracing AI tools, reflecting positively on Microsoft's strategic collaborations. These ventures not only diversify Microsoft's revenue stream, but also position the company as a leader in AI innovation. However, recent developments at OpenAI creates a huge risk for Microsoft's future growth. And what do I mean by that? Well, co-founder and CEO Sam Altman got fired by the board for not being consistently candid in his communications with the board, hindering their ability to exercise its responsibilities. The board no longer has confidence in his ability to continue leading OpenAI. And Greg Brockman, chairman of the board, got booted from the board and later resigned. And key researchers also quit, and employees demanding to have Sam Altman reinstated as CEO, or else they will also departure. This have hurt OpenAI and also Microsoft, that has a 49% stake in OpenAI. And the innovation that are developed by OpenAI is later scooped up by Microsoft and integrated in their tools and offerings, so this can really hurt Microsoft. So what do we know about Microsoft's business? Well, Microsoft develops and supports software, services, devices, and solutions globally. The productivity and business process segment covers Office services, Microsoft 365 Copilot, LinkedIn, Dynamics 365, and the intelligent cloud segment includes server products such as Azure and enterprise services. The more personal computer segment includes Windows devices like Surface and Xbox, gaming and search and news advertising. Founded in 1975, Microsoft is headquartered in Redmond, Washington, and sells products through various channels, including OEMs, distributors, and digital marketplaces. What Microsoft products and services do you use? Please let me know in the comment sections below. If we look at the numbers, we can see that Microsoft is traded on NASDAQ and are in the technology sector. Their market capitalization coming in at $2.4 trillion with a revenue of $211 billion. Now, they have a PE ratio of 34. If we take a closer look, we can see that the PE ratio have been dropping from 57 down to 34. And whenever you see a stock with a high PE ratio, that basically tells you that the market expectation of that stock is high, and therefore you might see capital gains on those stocks. But the overhanging risk is, if the company cannot meet those expectations, we will see the stock price fall. Same thing goes whenever you see a stock with low PE ratio, that basically tells you that the market expectation of that stock is low, and therefore you might not see capital gains on those stocks. Now, the profit margin coming in at 34%, and the price to sales ratio and the price to book value coming in 11 and 12, making it a bit overvalued. So if you are more a careful investor, you might find Microsoft to be overvalued. But if you're more a risk taker, then you might see opportunities here. The great news if you are a dividend investor, because they do pay out a dividend and have been doing so for over the years. And we can see here that the dividends have been growing year by year, and which is amazing. And we can also see that they have had a growth ratio of approximately 10% year by year. So having an increase year by year, but the dividends is just amazing. Now, they have an effective return of 0.8%. Me personally, I like to look at companies with an effective return between 3 and 6%. But at the same time, I don't just jump the gun whenever I see a stock with a high effective return. And why? Well, because it could be a trap. You see, I like to take a step back and look at the overhanging picture. Is the business expanding? Is it consolidated? Is it declining? Because the reason why it could be a trap is that you might get good returns as long as you hold the stock, but whenever it comes time for you to exit the stock, you might not get a higher price than what you actually paid for the stock. One stock that comes in mind is AT&T. Can you think of any other companies that comes in mind? Please let me know in the comment section below and let's share with the community. Return on equity at 38%, which is great. Basically, return on equity tells you about a company's ability to create return on the capital you're about to invest in them. And return on assets coming in at 14%, that tells you about how effective the company utilizes their assets in order to create profits. So let's take a look at the stock. The stock is currently traded at $369 per share. If we go down to the moving average, we can see that it's higher than both the 50 and the 200-day moving average, indicating that we might see the stock price continue to increase. As we can see, looking at the chart, is that the stock price had been moving within a positive trend line for quite some time. Now, do you remember we saw that the PE ratio have been dropping over the years, but at the same time, we are seeing that the stock price is actually increasing. So what is going on here? Well, we'll take a closer look later on, but let's head over to the income statement. Why are we interested of the income statement? Well, the income statement tells us about a company's performance, and what we are interested here is the revenue and the net income. And we can see here is that the revenue went from $143 billion up to $219 billion. If we take a closer look, we can see the growth of year over year, but also the rate which the revenue have been growing over the past years. We can see here 17% here between 2020 and 2023. It grew by 6.8%. And the good thing is, though, you have this model which lists all the companies within the same industry. So if we need to compare Microsoft's performance with other companies, we can do it. So if we find a company that we want to take a closer look at, we can just click on this show companies, and it actually loads that data in the background, which is just amazing and saves you a lot of time. But let's head over back to Microsoft. Now let's look at the net income, and what we can see here is that the net income went from $44.3 billion and grew to $72.4 billion over the years, which is just amazing. But one clear thing, though, is that we are seeing that the rate of the growth is actually declining, which is negative. But at the same time, the business is still growing, but not as much and not as fast as it used to. So that is a big concern that we need to investigate further on. But let's head over to the outstanding shares, and we can see here is that the basic outstanding shares went from $7.6 billion down to $7.4 billion. And this is amazing, because what is happening here is that the company are doing buybacks, meaning that there are fewer and fewer available shares out there, making your share of the company as an investor grow. If we were to see these numbers increase, that would mean that the company are issuing shares, meaning that as for an investor, you're being diluted, meaning that your share of the company is actually decreasing. So there's a lot of investors that either skip this part or doesn't know about it, because they've been looking at the company's income statement and balance sheet, and they say, hey, this business is performing well and their financial structure is on point. But on the other hand, the company are actually issuing more shares, meaning that they are diluting the investors, because that's a way for a company to bring in more capital without taking on more debt. So keep that in mind. Now let's head over to the balance sheet. Why are we interested in the balance sheet? Well, the balance sheet tells us how the company finances its operations. And what we're interested in is the financial strength of the company, starting by looking at the difference between the current assets and their current liabilities. And the current assets are all the assets that are expected to be converted into cash or used up within 1 year or one operating cycle. And the current liabilities is sum of all short-term financial obligations or debts that are due within 1 year or one operating cycle. And we can see here is that the total current assets came in at $184 billion. If we look at the total current liabilities, it came in at $104 billion. That is a huge difference. Basically, what that tells us is that if Microsoft were to convert their current assets to cash, they're able to pay off their current liabilities and still have capital left on hand, which is amazing. But they are far from being able to pay off the total liabilities at $205 billion. But at the same time, we can see here that the total liabilities have been growing year by year over the past 5 years from $167 billion up to $205 billion. But one positive note, though, is that we can see that the rate of the growth is actually declining, which is amazing. Now, let's head over to the cash flow. Why are we interested in the cash flow? Well, what the cash flow does is that it tells us about how the cash flows through the company and how its impact on the company's ability to meet short-term and long-term obligations, how they invest for growth, and how it manages its capital structure. And there are 3 areas which we are interested in, and there are the operating activities, the investing activities, and the financing activities. The operating activities tells us about the cash generated or used in the day-to-day operational activities, and the positive cash flow from operating activities indicate that the company can generate cash from its core business. And we can see here it went from $60.9 billion up to $87.4 billion, which is a plus. Investing activities gives us insights into the company's investment decisions and its commitment to long-term growth. And here we want to look at the capital expenditures, which we can see went from $15 billion to $28 billion, which is a plus because they continue to invest in their business, which is amazing. And lastly, financing activities gives us insights into how the company is financing its operations and how it manages its capital. And here we look at the free cash flow, which is the cash that the company is able to generate after accounting for capital expenditure. And here we see similar patterns that the free cash flow have been increasing over the years, but the rate of growth is diminishing, and that in the 2023 ended up a bit lower compared to the 2022 numbers. So it is moving in the right direction, but a small decline is actually appearing. But let's head over to the key figures. Here we have gathered all the key performance indicators to really sum it all up and give us a more holistic overview of Microsoft's performance. It's divided into 4 categories: dividends, profitability, financial strength, and valuations. And we can see that the earnings per share and the equity per share have all increased over the years, which is amazing. Only earnings per share and revenue per share have fell off a bit in 2023, but the overall development is positive. And looking at the dividends per share, we can see it went from $1.99 up to $2.66. And these numbers have been growing year by year. And we can also see that the annual growth has been approximately 10% over the years, which is amazing. And the dividend payout share have been fluctuating between 34% and 26%, which is great. Me personally, I like companies that pays out less than 60% of the capital because I want some of the capital to remain in the business for acquisitions, for investments, or just overall improving their financials. So that is great. The gross margin here, we see a fluctuation between 67 and 68, so not a huge development. But at the same time, these are great numbers, but we also need to understand why are they not improving? Why is the cost of goods sold the same? And we need to compare these numbers across the industry and see how Microsoft's competitors are doing. But these numbers are great numbers. Operating margin looking the same, a bit of improvement, but has more or less stagnated, so ranging between 37 and 41%. And the same thing here, these are great numbers, but I would like to see them continuously improving. Same thing goes with the profit margin. Great numbers here, fluctuating between 30 and 34%, 36%. Great numbers. Same question here. Why is these numbers not improving? So they are stagnated more or less. Return on equity went from 37% down to 35%, but at the same time, these are great numbers. Return on assets went from 14% up to 19%, have been fluctuating around those levels. And those are great numbers as well. Solidity tells you about a company's financial strength for the long term. We can see a huge development here over the years. These numbers have really been improving year by year, so that is great. Balance sheet liquidity went from 1.6 up to 1.8. That is great. Balance sheet liquidity, same thing as solidity, but here it lets you know about the company's financial strength for the short term. Debt ratio went from 1.6 down to 1. And we can see here when it had 1.6, that means that the company had 1.6 times more debt than equity. So these numbers are dropping. That is amazing. Now, the working capital is the difference between a company's current assets and the current liabilities. It measures the company's short-term financial health and operational efficiency. And we can see that these numbers have been dropping, so that is negative. And the capital turnover is the ratio that measures how effectively a company uses its capital to generate revenue. We can see here that these numbers are declining. They recovered a bit in 2023, but overall trend is negative. And we can see here, if we go over to the valuation here, is that these numbers have been all dropping. So as we saw earlier, is that the PE ratio is dropping, the price to sales ratio is dropping, the price book value is dropping. But at the same time, the revenues is increasing, the stock price is also increasing. This basically tells me that the business is growing faster than the stock market. But that also indicating a decline in the market expectation of the company. So guys, we have laid down a clear path forward when it comes to analyzing a stock. We have gone through the stock overview, the income statement, the balance sheet, the cash flow, the key figures. Now over to our key feature, which is the stock analysis tool. And what it does is that it gives you a holistic overview of the company's performance, and it saves you so much time. In just a quick glance, you get a overview of how a company is doing. For instance, we can see here that Microsoft gets in this profile a Finvy score of 43, which is classified as weak. The stock price is overvalued. The stock is actually consolidating right now, but is eventually it indicates that the moving average that it will increase. We can see here the PE ratio is above 20. The price to sales ratio and the price to book value is above 1, making the company overvalued. We can see that the revenue have increased over the past 5 years. Profit margin are higher than 15%. Profits increased the past 5 years. Free cash flow have increased over the past 5 years. Gross margin have improved over the years. Guys, as you can tell, it gives you a holistic overview of the company's performance. And it doesn't stop there. If you want to make sure and see, okay, is Microsoft the best option for me? It's so easy to find out. Just click on the tab industry and you get to see how the company is actually performing. So guys, if you want to step your investment game up, make sure to head over to finvy.io and get started today. And as with any investment, I just want to say, make sure to conduct your own analysis. Okay? Thank you guys so much for tuning in today's analysis on Microsoft. I hope you found this valuable and would like to see more. Make sure to like, subscribe, and comment and support the channel. The more engagement we get, the better content we will be able to produce. So if you haven't tuned in, make sure to tune in now, okay? And until next time, guys, thank you. Take care. Bye-bye.